webinars. And we have been on the series of getting started with technical analysis. And currently we're in chapter 4 of this series, wonderful series. A lot of people have been taking advantage of each lecture that has been coming their way on this. And we're expecting more momentum following each webinar that comes up and each understanding from each client. And today, as the case is, we'll be discussing oscillators, is chart analysis still valid, and a lot more. So you tighten your seatbelts. Let's continue of this wonderful learning experience and make sure we're going to be explaining everything as regards oscillators. Then we'll delve down to chart analysis. Is chart analysis still valid on the charts? Understanding what chart analysis is all about and knowing if it's still valid for traders to work with. So let's kickstart this wonderful explanation to these things as we get the best out of this session. All right, next page. Now we're talking escalators because I know millions of things that won't work, but we have certainly learned a lot. Now, with chart analysis, traders commonly use a variety of price-based mathematical formulas called technical indicators to evaluate price activity and make trading decisions. Now, among the most popular indicators are those tools loosely referred to as oscillators, which is that a group that includes the relative strength index RSI, stochastics, and then we have moving averages, which are convergence, the divergences of MACD, momentum, and the rate of change ROC, amongst others, perhaps because they are most often used as counter trend indicators to identify short-term price reversal points rather than long-term trends. Now, oscillators naturally appeal to many traders, contrarian inclinations, and we will be checking figure 6.1, which shows the RSI and stochastic below a daily stock chart. Okay, next page. Now, why the arcane names and imposing formulas of many oscillators may initially seem a bit confusing, we are virtually all these indicators are based on the concept of momentum, which not surprisingly refers to the rate or speed at which prices do change. And of course, the significance of momentum has two major components, and of which the first is the healthy price trends. It tends to exhibit strong momentum, while weakening trends often have a stagnant or, let's say, decreasing momentum, and alerting a trader to a possible trend reversal or more like correction. We'll consider a stock that gains a half point one day, 1 point the next, and 2 points the day after that, and 3 more the following day, and 4 points the next day. So we can then consider this a stock, of course. All right, next page. Next page, please. Now on the second, which is now having an overview of this, we are seeing the relative strength index and stochastic shows on pre-Cup, and we are looking at important support zones right at 30. Now that gains 2 points in one day and loses a point the next day, which gains a half point each of the next 2 days and gains a quarter point the day after that. While both stocks have risen over the five-day period, we have the first stock, which is obviously moving with much greater force, that is, showing greater momentum than the second stock, of course. And this, of course, has the ability to really shape things well and momentarily push things to what is expected, supposed to be. Okay, next page. Now, the second, which is momentum indicators, also highlight short-term market extremes or exhaustion points referred to as overbought or oversold levels. And the logic is that extremely strong, rapid price moves are not indefinitely sustainable. And when a market rises or falls, a great deal over a relatively short time period, like the first stock example in the preceding paragraph, prices will frequently reverse, and at least we have temporarily some things that even the strongest of trends is punctuated by retracements of varying degrees. But momentum oscillators are designed to really capture such important, very important turning points. Okay, next page. Basic oscillators. Momentum can be measured in several ways, and the simplest method is by subtracting the price end days ago, number of days ago, of course, from today's closing price. For example, you have a 10-day momentum, which is equal to today's close 10 days ago, and a similar measure is the ROC, the rate of change, which calculated as today's price divided by the price end days ago. Now, both indicators include a horizontal midpoint called the equilibrium line, and values above it mean that the current price is higher than end days ago, and below it means the exact opposite. While rising values above the line show increasing upward momentum, while falling values below the line indicate strengthening downward momentum. Now we have extreme readings above or below the line, which suggest overbought or oversold conditions. And some of these extremes may align with short-term price reversals, and trends also affect the indicators. For example, you have more oversold signals in a downtrend and more overbought ones in an uptrend. And as much as with moving averages, we have the number of days being used in an oscillator calculation determining how sensitive the indicator is going to be. And for example, you have a whole lot of things like that that really explains how it's going to work. All right, next page. Now, we have a 5-day momentum study. We'll closely track the short-time market fluctuations that a 20-day momentum study would. Similarly, the reversal portended by a 5-day oscillator would generally be proportionally smaller to that portended by a 20-day oscillator. So we're having a look at this chart now, and we're seeing overbought regions. Similarly, we're seeing oversold regions, and that very important equilibrium line that should max out a 10-day momentum of 1.88. And of course, we paid attention to the oversold regions that started from below 1.3 and started moving high upwards towards the equilibrium line. So this, of course, shows that the 5-day momentum study reflects more of the smaller market swings, while the 20-day study mostly reflects the major turning points, which of course has or had a significant effect on the market shape and the market structure. Okay, next page. Moving averages can also be used to construct momentum oscillators. Figure 6.4 shows price supremmost with a 20-day moving average. And below the price series, we saw an oscillator constructed by subtracting the moving average from price. And as price rise and fell, it moved above and below the average. Now, the faster price moves above or below the average, the greater the momentum being displayed. And the farther price is from the average, the more extended or rather overbought or oversold the price move will be. Now, longer moving averages will reflect more significant trends, while oscillator based on longer averages will reflect long-term price swings. And we need to note that the equilibrium line, 0, represents identical price and moving average values. And when the oscillator crosses above and below this line, it is equivalent to price crossing above and below the moving average. So an oscillator, or rather a similar oscillator to the one just described, is called the price oscillator, which instead of subtracting a moving average from price, it subtracts a longer term moving average from a shorter term moving average. Next page. Now we have comparison of a 5-day and 20-day momentum indicators. We have 5-day momentum, we have a 20-day momentum, and then we have oscillator resulting from subtracting moving average from price. And these things are really shaping how the market looks like these days. Next page. The previous figure showed that a price series with 10 and 20-day moving averages, and below it, the oscillator that results from subtracting the 20-day average from the 10-day average. The price oscillator is essentially an alternate depiction of the basic moving average crossover system described in chapter 14. And the arrows on the chart indicate points where the shorter average crosses above or below the longer average. And these crossover points correspond to where the price oscillator crosses above and below its equilibrium. Now, similar to the relationship between momentum and rate of change, moving average based oscillators can also be calculated by division instead of subtraction, that is, dividing price by a moving average or dividing a shorter term average by a longer term average. And this, of course, resulting indicators are very equivalent to what we need to work with. Okay, next page. Now we have some comparison, moving average crossover and price oscillator. And then we have figure 6.6. The only difference you can see here is moving averages being put and then was removed. But the MACD line was shown, and as well as the signal line, and the histogram of difference between the MACD and the signal lines actually dissected what position or what trend was about to kick off. Next page. The well-known MACD moving average convergence divergence is a variation of price oscillator. It measures the difference between two exponential moving averages, typically 12-day and 26-day, and then plots a 9-day moving average of that difference, known as the signal line. And of course, the basic trading rule is to buy when the MACD crosses above the signal line and sell when it crosses below. Similar to a moving average crossover, the histogram represents the difference between the MACD and the signal line, highlighting these crossovers. Now, to filter out weaker signals, traders can, of course, define overbought and oversold zones and only act on crossovers within those areas, because a price escalator using 12-day and 26-day averages would of course resemble the MACD minus the 9-day signal line. We have in figures 6.1 to 6.5 show how different oscillators, despite varied formulas, often look similar, highlighting the most popular oscillators are just variations on a few basic concepts. Next page, please. Now, indicators like momentum, rate of change, price oscillator, and MACD are unbounded, meaning they have no fixed upper or lower limits. And of course, to identify overbought or oversold conditions, traders often define custom levels, commonly the top and the bottom 10% of past readings based on historical peaks and troughs. And however, these levels may not stay relevant as market conditions do change, but overbought signals may suggest selling opportunities, while oversold signals may suggest buying. But traders can use these cues to enter new positions or manage existing ones, for example, by going short, closing or trimming a long position, or tightening the stop loss orders. Of course, timing such actions depends on strategy, such as acting on the initial breakout and then after reversal, upon exiting the extreme zone, or only when confirmed by a price pattern. The latter often being the most reliable, will mean that indicators like the RSI and the stochastics will be normalized oscillators rather than have a fixed upper. So these things are usually very impounded and has the ability to radiate the energy that comes with understanding how the market shape works and how everything is supposed to be. So oversold conditions are very important, as well as the overbought conditions. All you just need to do is identify them. You should have no fixed upper or lower limits, of course, and having in mind that overbought signals may suggest selling opportunities, while oversold signals may suggest buying opportunities. Timing is very important. Based on your strategy, timing is very important. Having the right time to sell and knowing the right time to buy. Next page, please. Now, the RSI and stochastics, for example, both range between 0 and 100. We have overbought and oversold, and levels for such indicators are commonly set equidistanced from the upper and lower limits. We know, for example, the 70 and 30 or the 80 and 20, although this is not required and will not even be appropriate in strongly trending markets. Figure 6.1 compares the 10-day RSI and stochastic. The additional line on the stochastic is a 3-day moving average of the basic stochastic, similar to the signal line of the MACD, and the RSI has overbought and oversold levels of 70 and 30, respectively, while the stochastic uses levels of 80 and 20, although the developers of these indicators suggest a variety of applications for these oscillators. Now, the fundamental information they convey is identical to that of the other individual indicators discussed in this chapter, because overbought levels are assumed to represent selling opportunities and oversold levels are assumed to represent buying opportunities. Next page, please. Now, besides overbought and oversold levels, another notable counter-trend oscillator signal is referred to as divergence. It describes the phenomenon of momentum moving in the opposite direction of price. And as mentioned earlier, waning momentum often signals a dying trend, and a possible reversal or correction. But a classic divergence refers to a higher price, higher accompanied by a lower oscillator, or a lower price, low accompanied by a lower oscillator, or a lower price, low accompanied by a higher oscillator low. Now, the implication is that the market has posted a new high or low, but momentum, by failing to confirm the price move with a new high or low of its own, is revealing trend vulnerability. Because, for example, every indicator in figures 6.1 to 6.7, with the exception of the stochastic in figure 6.1, shows a classic divergence between the February 1997 price low and the lower April 1997 price low. Now, the April indicator lows are higher than the February indicator lows. Now, in a rising market, a typical response to divergence is to short the asset or reduce or exit a long position to manage risk. It shows an uptrend with a 10-day RSI below the price chart. At points A, B, C, and D, price makes higher highs, but RSI makes lower highs, indicating a bearish divergence where momentum weakens despite rising prices, and this often signals a potential reversal. Such divergences in uptrends are called bearish, while in downtrends, bullish divergences signal possible price increases. Unfortunately, divergences rarely occur only between the penultimate and final peaks in an advance or the last two lows in a downtrend. Next page. Now, we are seeing RSI 50.75, 30, 70, and this is currently a chart. Repeated false divergence signals in a trending market. And paying attention to this momentarily, we are seeing bearish divergences between price and oscillator, bearish divergences between price and oscillator at XYZ and at ABCD. So divergences often occur in series. That's what we're trying to point out here, as seen between points AB to BC and TD. And a trader who shorted after the first divergence A to B would have acted too early, with the market continuing to rise after a brief dip. But earlier divergences at points X, Y, and Z would have led to even earlier and premature entries. But this shows oscillators can skew in direction of the trend during the uptrend, and the oscillator repeatedly signaled overbought conditions without showing any oversold signals, which lead into false sell signals and no useful buy signals. To address this, overbought or oversold levels should be adjusted according to the trend. And for example, raising the threshold in an uptrend to reduce noise and improve signal quality. Right? Next page. Now, while the traditional counter trend approach of selling when the oscillator is overbought and buying when the oscillator is oversold, it may provide excellent entry points in trending ranges. It's a recipe for disaster in trending markets. As the previous example shows, unfortunately, however, it is impossible to know when the trend will end and the trading range will begin. But unless stops are used to limit risk, counter trend oscillator signals can lead to large and repeated losses. Because of these limitations, we have oscillator signals which are often used at trading alerts, warnings of possible price developments. Positions are established only when price confirms a reversal. And for example, when an oscillator moves above its overbought threshold, it alerts the trader that the market is overextended and may reverse, and the trader would then look for a definitive price signal before initiating a position. Next page. Now, is chart analysis still valid? According to Marty Schwartz, he said, "I always laugh at people who say I've never met a rich technician. I love that. It's such an arrogant, nonsensical response because I understand fundamentals for 9 years and got rich as a technician." Now, most traders who have never used chart analysis or even somehow have and are skeptical about this approach. Some of the commonly raised objections include such a simple analytical approach work. Options are hardly a secret and when floor traders sometimes push the market enough to trigger chart stops artificially. So even if chart analysis worked before it was detailed in scores of books, isn't the method too well publicized to still be effective? Although the points raised by these questions are basically valid, we have a number of factors explain why chart analysis remains an effective trading approach. All right, next page. Now, we speak of risk control because risk control, trading success does not depend on being right more than half the time, or far for that matter, even half the time, as long as losses are rigidly controlled and profitable trades are permitted to run their course. For example, you consider a trader who in March 1991 assumes that September 1992 euro dollars have entered another trading range and decides to trade in the direction of any subsequent closing breakout. We have figure 7.2 indicates the initial trade signals and liquidation points that would have been realized as a result of this strategy. And this implicit assumption is that stops are, placed at the midpoint of the trades. Now, take a look at the chart. We are seeing trading range, zigzag manner, buy, sell, buy, sell, buy, sell. And then we saw another trading range, zigzag manner, but then it escalated to the top and then fell back immediately. Now, trading range markets are very, very, honestly, they're very, very deceptive sometimes in trading. But if you get a hang of it, you're able to make consistent profits from it and able to, keep the ball rolling and never stop making twice as much multiple streams of income from such setups. Now, trading range markets, I always say this and I'll never stop saying it to people. We always buy when there's a sell market and you sell when there's buy market. Okay, next page. Now, trading ranges, the relevant consideration in choosing stop point are discussed in detail in chapter 9, and as figure 7.2 shows, the first two trades would have resulted in immediate losses. However, it illustrates that the third signal proved to be the real thing, indicating a long position in time to benefit from a major price advance that far exceeded the combined price swings on the prior two adverse trades. Now, although 2 out of the 3 trades were losers, on balance, the trader would have realized a large net profit. And the key point is that the disciplined adherence to risk control principle is an essential ingredient in the successful application of chart analysis to trading. And number 2, we talk about confirmation conditions. Chart analysis becomes more effective when trades are confirmed rather than acting on a very technical signal, because there's a trade-off. We have looser rules which lead to more false signals, while stricter ones can delay entries and reduce profits. Common confirmation methods include time delays, minimum price movement, or specific patterns, e.g. confirmation by 2 strong days in signal direction. And there's no one size fits all rule. What works best varies by market and over time. Ultimately, confirmation strategy should be tailored to the trader's judgment and experience, making them a key part of personalized analysis. Okay, next page. Now, as an illustration of how confirmation conditions might be used, we consider the following set of rules. First, you wait 3 days after signal is received. For buy signal, you enter trade if the close is above the high, since the signal was received on the first subsequent day fulfilling this condition, an analogous condition would apply to sell signals, and these rules would have filtered out the losing match and made signals while only modestly delaying the entry point for the subsequent highly profitable buy signal. Of course, one could also construct examples in which the use of confirmation conditions is detrimental to the trading results. However, the key point is that the use of confirmation rules is one of the primary means of transforming classical chart concepts into a more powerful trading approach. Now, putting chart patterns in context, chart analysis is more than just the recognition and interpretation of individual patterns. And one of the earmarks of the successful chart trader is an ability to synthesize the various components of the overall picture. For example, the trader who recognizes just a trading range in September, 92 euro dollars, would treat upside and downside breakouts equivalently. However, the more experienced chartist will also consider the broader picture. Next page. Now, while preceding example benefits from hindsight, it illustrates the multifaceted analytical process of the experienced chart trader. It should be clear that the skill and subjectivity implied in this approach place chart analysis in the realm of an art that cannot be mimicked by merely following a set of textbook rules. But this is a crucial point in understanding how the chartist approach can remain valid despite widespread publicity. Now we have knowledge of fundamentals. If a trader has decent skill in fundamental analysis, combining it with chart analysis, it can enhance decision making. For example, if fundamentals suggest a strong long trend uptrend, only bullish chart signals should be acted upon. And if the outlook is neutral, both buy and sell signals can be considered. And this approach gives traders who understand both fundamentals and charts a clear edge over those relying solely on technical analysis. Next page. Using failed signals. Now, the failure of a market to follow through in the direction of a key chart signal is a crucial item of information often overlooked by novice chartists. Recognizing and acting on these situations can greatly enhance the effectiveness of the chartist approach, and this subject is discussed in detail in chapter 11, and the most important rule in chart analysis is to understand these approaches. Next page, please. Now, in conclusion, the skeptics are probably correct in claiming that a Pavlovian response to chart signals will not lead to trading success. However, this is in no way contradicts the contention that a more sophisticated utilization of charts, as suggested by the cited factors, can indeed provide the core of an effective trading plan. And in any case, chart analysis remains a highly individualistic approach, with success or failure critically dependent on the trader's skill and experience, of course, because it would be unreasonable to expect or play the violin well without some degree of practice and innate talent, because chart analysis is, of course, no different. Next page. And that's all on today's insightful topic, oscillators and chart analysis. The chart analysis still valid, and we really hope you enjoyed every bit of it, and we are expecting to see you again next week on this series. We still have a lot to talk about. It might be a new topic, it might still be a new series, or we just want to we want to keep you in the dark, of course. We just want everything to move smoothly, and wish you success in all your trades, successful trades, racking profits, and of course, enjoy your weekend as well. Thank you.